Hello, this is Mike Swanson. You're listening to the Inside Wall Street Window podcast. This podcast, I'm going to tell you what I'm doing in the stock market. So a few weeks ago, I sold all the stocks I bought last year. Last year, I turned bullish on the stock market in January. You can find articles where I said that on my website, and there's a couple of YouTube videos too. At the time, I was saying I think we're starting a new cyclical bull market that would last probably 2 years. I don't think it's necessarily over, but we're now in the second year of this. It could go up in the summer, it could go up into the end of the year. We'll see. But the important thing is, at the beginning of last year, I thought, okay, we're starting a short-term cyclical bull market, probably 2 years. And those type of bull markets occurred. There are multiple of them from 1968 to about 1981 in the U.S. stock market. And you can find other markets, cyclical bull markets, in history and other markets around the world, commodities and so forth. And typically all the gains come at the beginning and a little bit more at the very end. And most of the time, there's not much going on. So we got big gains at the beginning of last year. And then from July to October, a correction and then a resumption of the move up. Now, I actually did some selling last year in July. Bought back in November, not selling everything, but some of the positions I had. Bought back early November as I saw that correction was over. And at the time, I was actually, the stock market's actually acting worse than I thought it was going to when I bought in November. So in November, there was a nice improvement in the internals of the market. The number of sectors going up improved for about 6 weeks. And a lot of stuff was falling from July to October as interest rates were going up, or yields were going up in the bond market. And then there was a low in that happening, and interest rates have come down a little bit in 2-year, 5-year, 10-year treasury bonds and so forth, and corporate bonds. And that helped drive the stock market rally. It helped sectors across the board in the stock market get a big lift. I was making note of how the REIT sector, utility sector, consumer staples sector were all getting a nice lift. But they weren't the only sectors, but they were the ones that interested me. What's happened, though, since January is that the stock market has acted worse than I thought it would. And I'm not talking about the averages here. Now, the S&P making a new high, that's nice. The NASDAQ doing well. But the sectors inside the stock market overall have done much worse than I thought they were. That nice improvement in the internals that took place in November and first half of December fizzled out. In fact, the internals turned down the percentage of stocks above their 200-day, 50-day, 20-day moving averages, all ended lower at the end of January than they were at New Year's, and they're still lower now than they were at New Year's, even though the stock market made a new high last week. This was stuff I was not expecting. And in fact, that REIT sector, that utility sector, they kind of fell apart. Those rallies completely fell apart. The rallies in consumer staples completely fell apart. Casino stocks completely fell apart. It's NVIDIA that's fascinating everyone. And you turn on CNBC, you saw it last week when they reported earnings. It's about all they talk about. NVIDIA and AI. That's it. And if you look at ads for what people are advertising about trading services, all about AI. All of it. So that's where we're at. And that's late stage bull market stuff when it's no longer broad based, but just one little segment of the market that's getting people interested. That doesn't mean we're starting a bear market this week. I don't think we are. But I wanted to take money off the table. It was sort of my plan when I first bought in the first quarter in January 2023. I was saying, look, back then, we're going to get the big gains at the beginning, and at some point it's going to be tough to make money in this market because the gains are going to be limited. And at that point, it would be best to be in bonds and dividend-paying stocks because you're going to need those yields to make any money. And I basically think that's roughly where we're at. Maybe the market will go up more, but I'll put it this way. For me, it's not worth the risk. I think it's like flipping a coin. I'm not telling you to sell your stocks. I'm not telling you we're going into a bear market tomorrow. All I'm doing in this video is telling you what I'm doing. And I'm doing it for another reason, too, which I want to share with you right now. So, in 2008, I shorted the stock market in July of that year and added those short positions in August. I was heavily short, and then the stock market melted down, and I made a lot of money. Now, I've tried to short things a couple times and get out real quickly since then, and have small losses on those trades. I mean, that's the only thing I was doing. And in the year 2000, I shorted stocks with a day trading strategy in the fall of that year and made a lot of money. So I like to go both ways in the market, but right now, my viewpoint, despite what could be seen as bearish talk, is I'm neutral on the short term what's going to happen here. I don't see any good trades in anything lining up right now as I'm doing this. I don't want to short stocks, but I don't see sectors that look exciting to me. Even the gold mining stocks are not acting right. They almost are acting like they did in the year 2000. It makes me wonder if we're in some sort of heading for a transition like has occurred that year for the financial markets. I don't think we're heading to a 2008 scenario of bank meltdowns and all that mess. But what I want to do myself, I made a lot of money over the years, and I don't want to gamble it trying to make another 5% on the stock market. When you can make 5% risk-free with bonds, short-term bonds. So that's basically what I'm doing with most of my money. A lot of it is, of course, in gold and silver, too, because those are core positions. But being basically out of the market right now, not trying to trade the market right now, puts me in a unique position, which almost no one is in that is putting out financial content, whether that's videos on YouTube or writing or being interviewed on CNBC or something. That unique position is being out. Being out enables you to look at things from an objective viewpoint. We're all human. When you have a position in the market, in a sector, whether it's long or it's a short position, it's going to color your thinking because you're going to want it to go in your favor, and you'll look for signs that it will. That's just human nature. But by being out, I don't need to do that, or I'm not going to do that. I want to be as objective as possible in order to position myself correctly when the next major market turn occurs. And I think one's going to happen before the end of this year or next year. Specifically, I do think we're going to have another bear market. This rally may continue. We may get a pullback and then a new high. So that's why I don't think this is a time to short or bet against the stock market at all. But I want to be on the sidelines. I want to watch. So I can swing at a fat pitch when I see it. I don't want to swing at subpar trades, lose my energy, or get discouraged or distracted, and then when the fat pitch comes, miss it. I want to have my eyes open for that fat pitch, and most people won't see it because they're stuck in the trades that they're going to have on or the positions that they got, coloring their thinking. That's what happens in the market to everyone in it, everyone participating in it. So I'm not participating in it that much, so I can watch and see, and then get excited to do something when the time is right. So that's what I'm doing in the markets, and just wanted to share that with you. And I'll be talking with you later.